Welcome to this short discussion on utility theory and risk aversion. Risk tolerance is a critical component of determining the appropriate assets for a portfolio. But underlying risk tolerance is utility theory, or the level of satisfaction, or UTILS, produced by a specific amount of wealth. These slides will take you through the development of utility theory and how a risk-averse investor values potential outcomes. It will then introduce you to the idea of indifference curves, which are discussed in Chapter 7. The final slides will provide a practical aspect to utility, how insurers use utility theory to determine the value of insurance premiums. Utility theory for risk-averse individuals has two primary assumptions. One, consumers prefer more wealth over less wealth, and two, each additional unit of wealth has diminishing returns. Risk-averse utility is typically graphed using a concave function. Many different formulas can be used to define this function, but most typical for explanatory purposes are the square root function and the log normal function. In each, the x-axis contains the underlying values, 1, 2, 3, while the y-axis will contain the function's output. The concave nature reflects the differences in the growth rates. While the x-axis grows at a constant rate, the y-axis grows at a diminishing rate. For example, if x is 2, 4, 8, and 16, the corresponding y values for the square root function would be 1.414, 2, 2.828, or 4. If the log normal function is used instead, this you can find on your financial calculator as the LN key. The corresponding values would be 0.693, 1.386, 2.079, and 2.773 respectively. Both functions satisfy the required assumption in that y will continue to grow with x, but at a decreasing rate. The other aspect of risk-averse utility curve is that the midpoint of any line that connects 2 points on the curve must have a lower y value than would be found by using the function. This establishes the curvilinear nature of the function. We will explore this rule in subsequent slides. The best way to demonstrate utility theory and risk aversion is through an example. Assume that an investor with $100,000 is offered two opportunities. One pays $150,000 and the other pays $50,000. The probability for each payoff is equal, or a 50-50 bet. The expected return for this investment is the standard equation: the expected return equals the probability of A times the expected return of A plus 1 minus the probability of A times the expected return of B. In this example, the expected return would be 0.5 times $150,000 plus 0.5 times $50,000, or $100,000. Because the expected return equals the initial value wagered, the bet is referred to as a fair game. To an economist, the investor should be indifferent as to whether or not he plays the game. If we were to play the game many times, he would win as often as he loses and would end up with the same amount of wealth. But this assumes that the investor values the game in the same way that the economist does. The real question is, does he? The log normal function is typically used to measure consumer utility. Again, the function satisfies the requirement that utility grows as wealth grows, but at a decreasing rate. If you enter 30,000 on your calculator and then hit the log key, it will yield a value of 10.309. If you enter 50,000 and hit the same key, you'll get a value of 10.8198. For a 67% increase in wealth, the investor gains 0.5108 more utility, or UTILS. If we move from $150,000 to $170,000, we gain a much smaller increase, this time only 0.1252 UTILS, even though the wealth rose by the same $20,000. In a log normal function, the rise in utility is based on the percentage rather than the dollar increase in wealth. For any x value in a log normal function, a rise of 67% will result in a 0.5108 rise in the y value. So to get the same increase in satisfaction that was achieved by going from $30,000 to $50,000, Someone who starts with $150,000 will need to see an additional $100,000 or 67% more increase in wealth. In economics, this decrease in the value of utility provided for each additional unit of wealth is referred to as the diminishing marginal utility. Because utility is another way to measure wealth, the utility values, or the logs, of $150,000 and of $50,000 can be substituted into the expected return equation. This will provide the expected utility for a bet with a 50-50 chance. This time, the expected return equals, again, the probability of A times the log of A plus 1 minus the probability of A times the log of B, or 0.5 times 11.9184 plus 0.5 times 10.8198, or 11.3691. Now, slide 1 stated that for a risk-averse investor, the midpoint of any line that connects 2 points on the curve must have a lower y value, or utility, than would be found by using the function. If the midpoint on the line connecting the log of 50,000 and 150,000 is 11.3691, what would you expect the utility of $100,000 to be for a risk-averse investor? If you guessed higher, you would be correct. In fact, at $100,000, utility is 11.5129, or 0.14 utils higher than with the weighted calculation for a fair game. Increasing wealth from $50,000 to $100,000 results in a 0.69 increase in utility. Adding another $50,000 yields a much smaller 0.41 increase in utility. Again, this is consistent with the law of diminishing returns, and it is consistent with the expectation for a risk-averse investor. The degree of the utility function's curvature reflects the underlying level of risk aversion. A very shallow curve might mean that the investor puts very little value on additional levels of wealth. This would be a highly risk-averse investor. A steeper curve for the same level of wealth would reflect a less risk-averse investor. A curve that is convex, in other words, it bends upwards, reflects a risk-preferring investor. Slide 6 shows the difference between the utility for a fair game and the utility required by the risk-averse investor. The outstanding question is, what is the game worth to this investor? That question can be answered by finding the value where the dotted line crosses the utility curve. The amount that the investor is willing to pay is the amount that provides the same degree of utility as with the fair game. For a risk-averse investor, this amount is lower than the original bet. In other words, the investor requires a premium to compensate for any utility risk. This is referred to as the certainty equivalent. Finding the wealth value that equals the utility value is quite easy on your calculator. Enter the desired utility value, in this case 11.3691, into your calculator, then hit the e to the x key. On most calculators, this is the second function for the same key that you used to find the log normal value. This value is referred to as the antilog. Think of it, along with the log normal key, as either finding the nth root, then using the same value to go back to the original value. For example, the square root of 25 is 5, and 5 squared is 25. Using the log normal function, the log of 5 is 1.6094, and the antilog, or e to the 1.6094, is 5. For our example, e to the 11.3691 is equal to $86,604. This is the maximum amount that this investor would be willing to pay for a game that provides a 50-50 chance to either win $100,000 or to lose $50,000. In your text, Boddy expands on this concept to create a utility function that incorporates risk aversion levels. Boddy's utility is equal to the expected return minus 0.5 times the risk aversion level times the standard deviation of the return. In other words, the function is expected return minus the risk. with increasing levels of risk aversion resulting in a greater risk discount. The table on this slide shows how the levels of risk aversion impact the investment's utility. An investor with minimal risk aversion, in other words, a value of 1, will realize much greater utility from an investment offering 13% return with a 20% standard deviation than an investor with a risk aversion level of 5. The next question is, what would be the expected return or certainty equivalence premium that would yield the same utility for varying levels of risk aversion? The next table shows the returns required for providing that same utility. The very risk-averse investor will require a 21% expected return for the same risky investment that required only a 13% return for the investor with minimal risk aversion. The trade-off of expected returns and risks that results in the same utility is used to create the indifference curves. Using the Bode function, the table and the accompanying graph on this slide shows the return to risk levels that provides a utility equaling 11. A risk-averse investor is indifferent or will derive the same utility towards a variety of choices with increasing standard deviations as long as they all provide sufficient returns and a utility that equals 11. The highly risk-averse investor's indifference curve has a much greater curve than the minimally risk-averse investor. As risk rises, so does the required return. The less risk-averse investor is willing to accept much greater levels of risk for that same potential return. Indifference curves are used along with the capital market line and the efficient frontier to determine the investor's acceptable proportion of risky versus riskless assets when building a portfolio. The steeper the curve, the greater the proportion of a riskless asset. Conversely, the flatter curve for the more risk-tolerant investor will result in a much higher level of risky assets. Utility theory is used for more than determining just asset allocation. In fact, the insurance industry uses the same concept to determine the amount that clients will pay to insure their house or car. Using actuarial data, the insurance company will estimate the likelihood of a client's house burning down or the client having an accident, and then will combine that data with the value of the house or the car to determine various premium levels. The customer will then choose the level of insurance based on their own relative evaluation of the value of that asset. The homeowner whose house is their primary asset may put a much higher value on their homeowner's policy than the homeowner with many other assets. Don't worry, that second homeowner will use an umbrella liability policy to cover those additional assets. Similarly, the owner of a 10-year-old junker will likely opt out of any replacement insurance, while the owner of a new car would be more than willing to pay the additional premium. The steps used to determine the acceptable premium are the very same steps used to compute the certainty equivalent. In this particular example, steps 1 through 4 are identical to the steps that we just went through in the slides above, while step 5 requires a little creative thinking along with some algebra. Try working through this problem before you move on. Step 1 is the determination of the year-end value for the two cases with no fire versus having a fire. The homeowner has $50,000 in cash in either case, which can be invested at a 6% return. However, the 50-50 odds that we discussed in the prior example are now changed to a 99.9% chance that the house will not burn down and a 0.1% chance that it will. Step 2 substitutes the utility using the log normal function again for the house value. Step 3 weights the value from step 2 by the odds that the events will occur to determine the fair game value. Again, this was the very same process that we used in slide 4 above. Step 4 is finding the certainty equivalence using the results from step 3. You've just found that the certainty equivalent is going to be e to the 12.439582, or $252,605. Again, This is the same process that we went through before. This is the amount of insured wealth that is equivalent to the value of the home plus the year-end value of excess cash after subtracting the insurance premium. Step 5 is the final calculation of that acceptable premium. The steps involved are very simple algebra. You start off with the formula that we just discussed of $200,000, the value of the home, plus $50,000 minus the insurance premium times 1.06 to reflect the 6% earnings. And that will equal the certainty equivalence. Using a little bit of algebra, we subtract $200,000 from both sides, and we multiply the $50,000 times 1.06. We then subtract the $52,604 remainder from the $53,000, and that way we get a premium, an initial premium of $395. But remember, this is similar to an annuity due that you learned about doing the time value of money. So now we have to divide that premium by 1.06 because this is a beginning of the year calculation. What you end up with is a premium of $372.71. Again, this is exactly what goes on by insurance companies when they're trying to determine what would be a correct insurance premium. The last slide reflects a second question, again found in the same appendix. This is taking the cost of insuring the same house that we just went through in question 1, and it gives you the amount of insurance per $1,000 of value. And it asks what is the certainty equivalent of the year-end wealth if you insure your home for 3 different values. Again, you'll go through steps 1 through 4 that you just went through in the prior example. Once the certainty equivalencies are found, compare them and discuss the level of insurance that maximizes the home's owner's utility.